let's wait for 2-3 minutes before we start the session. Good morning, everyone. Thank you for joining us today. I'm really excited to talk about something that doesn't always get the attention it deserves. The importance of investment behavior or soft skills when it comes to managing money. Excellent. So before we get into, I'll just quickly give a disclaimer. This presentation is solely to showcase our business analysis and what we think about investment behavior. And there will be some companies that are going to be discussed, but it's not a buy and sell recommendation. Please consult your financial advisor before acting on it. Sure. Let's move on. So why investment behavior matters? We often think of finance as something technical, like plugging numbers into a formula, getting the results, and just doing what the formula says. And yes, that's a part of it. Whether it's setting up an emergency fund, saving a percentage of your salary, or understanding the relationship between interest rates and investments. All of this involves numbers and logic. But here's the catch. Knowing what to do and actually doing it are two different things. And it's time to act when you start staring at your finances, making decisions under pressure. What happens in your head plays a much bigger role than any formula ever could. Money touches all of us, and yet it often leaves us feeling confused. And that's because it's not just about math, it's about emotions. It's about understanding risk, building confidence. For example, to understand why people take on so much debt, just knowing about interest rates won't be enough. You need to understand how insecurity or even optimism can influence such decisions. Similarly, when investors sell at the worst possible time, for example, let's say at the bottom of a bear market, it's not because they didn't know better. It's because their fear and anxiety took over. There's a quote that says, history never repeats itself, man always does. And it perfectly fits here. Our behavior with money tends to follow patterns, often without us realizing it. In this session, we will explore some of the most important and surprising lessons about the psychology of money. Our goal is to help you not just understand these ideas, but to use them to make better financial decisions in your own life. Let's get started. Next slide. Let's explore the concept of the behavior gap. Simply put, it's the difference between the returns an investment generates over time and the returns an investor earns. This gap exists not because of the investments themselves, but because of our behavior, our emotional reactions to market events. The key to closing this gap lies in understanding that successful investing isn't about intelligence. It's about discipline and consistency. Even when average investments, staying calm and avoiding emotional decisions can help you achieve better results. So the best approach, set it and forget it. Once your investment aligns with your goals, let them grow. It's much like planting a tree and giving it time to flourish. Remember, those impressive returns you see on paper, they assume you invest and leave it untouched. In reality, emotions often lead to buying, selling, or switching at the wrong times, widening the gap. Ultimately, your real returns reflect your actions, not just market performance. Now let's dive deeper into the root cause of the behavior gap, the psychological biases. These biases are driven by our lizard brain, the part of us that reacts instinctively to threats. While it's great for survival, it doesn't always serve well when it comes to investing. So here we have listed out some of the common biases and how they widen the gap. First is herd mentality. See, following the crowd leads to bubbles and crashes. So focus on your own fundamentals instead. Confirmation bias. We stick to what supports our beliefs and ignore the rest. But staying open to all data helps avoid this. Anchoring. Holding on to past prices clouds judgment. Instead, base decisions on today's reality. Giving too much weight to recent events can lead to impulsive decisions. Remember to think long term. Focusing too much on avoiding losses can hold you back. Keep the bigger picture in mind. Selling winners too early and holding on to losers too long is very common, and we have all experienced that. So balancing these decisions with logic and not emotion. Mental accounting. Treating money differently based on its source can lead to poor decisions. Remember, all money works the same way. Overvaluing what you own just because you own it can hurt your portfolio. Prioritize performance over attachment. So, what can we do about these biases? Stick to a clear and well thought out plan. Maybe automate your investments to reduce emotional interference, and maybe seek professional advice when you feel uncertain. The good news is that we can control our lizard brain with the right strategies. By staying rational and disciplined, I think we can close the behavior gap and achieve much better outcomes. Next slide. So let's now talk about the dark side of investing behavior. No matter how experienced you are, certain emotional habits and mental traps can challenge you throughout your investing journey. Understanding these traps is crucial because they can lead to poor decisions, even when you have the best intentions. Fear drives us to sell during downturns, locking in losses, while greed push us to chase risky opportunities at market peaks. For example, fear makes us panic during crashes, and greed tempts us to overcome it during rallies. And we have all experienced these, maybe often at the worst times. So there's a very famous saying by Warren Buffett: never risk what you have and need for what you don't have and don't need. So managing this emotion is essential to sticking to your strategy. Next is overconfidence. A few successful investments can trick us into thinking we can always beat the market. This overconfidence leads to taking higher risk and often results in losses. Remember, luck often plays a bigger role than we realize. So stay humble and realistic no matter how good things are looking. Next is emotional trading. See, trading based on emotions like frustration or excitement or revenge rarely ends well. Impulsive decisions, such as revenge trading to recover losses, often compound the problem. Staying calm and rational is key to avoiding this trap. This is FOMO. The fear of missing out can push us into investments we don't understand. Just because others are succeeding in it, we think we can also do. Envy can shift our focus from our own goals to chasing trends. Eliminating FOMO and envy helps us concentrate on long-term growth and avoid getting trapped into bubbles. Short-term focus. See, focusing on daily market fluctuations and seeing the prices of stocks on a very continuous basis often leads to impulsive decisions and missed opportunities. Instead, we should keep our eyes on long-term goals and stick to our financial plan. Unrealistic risk-taking. Taking risks without fully understanding the downsides is a pure recipe for disaster. Risk is necessary, but it must be calculated and you must be aware of it. What type of risk you are taking, it should be within your risk appetite. Avoid chasing high-risk opportunities without preparation. Resistance to change. Markets evolve continuously, and I think so should we. Sticking to outdated strategies or avoiding new opportunities can lead to missed growth. Adaptability is a key trait for success in investing. A very important point is the overtrading, like frequent buying and selling increases cost, taxes, and stress, resulting in worse outcomes. Patience and discipline are more effective than chasing every market move. So, investing isn't just about strategies or analysis, it's truly a battle of the mind. Emotions like fear, greed, impatience, overconfidence, etc., can easily derail even the most well thought out plans. To succeed, we need to recognize these emotional demons, quiet them, and stay focused on the bigger picture. Remember, the key to investing lies in mastering your behavior, not just the markets. Next slide. So now, having explored the emotional and psychological traps that can derail us, it's clear how important it is to manage our emotions and stay disciplined. However, despite this understanding, certain emotions often take over and lead us to make certain common mistakes. In the next few slides, we will try to focus on some specific scenarios where these emotions tend to dominate and how we can navigate them effectively. So, let me start with a simple analogy: diet plans. Most diet plans work if followed consistently, but we often lose patience, blame the diet plan, and maybe jump to the next trendy option, right? I think the issue is not the plan, it's about behavior and discipline. Same applies to investing also. Creating a perfect investment plan isn't the challenge. I think sticking to it is. Along the way, moments of doubt will tempt you to abandon your plan and chase something else. Success lies in preparing for these moments and staying committed no matter what. Common time when investors go off track is during bubble markets. So, what is bubble market? A bubble occurs when asset prices rise far beyond their true fair value, maybe due to excessive demand or speculation, eventually leading to a sharp decline. For example, we had the dot-com bubble or the global housing bubble, right? But the tricky part is that spotting a bubble in real time is real difficult. What looks like a bubble sometimes could just be natural growth or short-term movements. The mistakes investors make during bubbles are very, very predictable. Some of them are listed here. See, first, investors sometimes forget about their original asset allocation plan and they go all in on equities, right? Sometimes they borrow money to invest or engage in speculative trading, hoping for quick gains. Then sometimes you'll see over concentration in some specific themes or sectors or stocks, right? So these mistakes are usually driven by a combination of greed and overconfidence. During a bubble, these three emotions tend to take over. So it can lead to investors discarding their original plan, dramatically increasing their equity exposure or particular asset class exposure and betting heavily on some sectors or some particular stocks, right? So we have seen some people even borrow money to invest, thinking the rally will never end, right? But when the bubble bursts, and it mostly always certainly does, right? The consequences can be severe, maybe resulting in a poorly diversified portfolio and maybe sometimes permanent loss of capital also, right? So next slide. So what can be the solutions, right? So basically, we need to stick to your plan, no matter how tempting it is to chase quick gains during a bubble. Focus on maintaining a well-diversified portfolio that is in line with your risk tolerance. And most importantly, stay humble and stay calm during bubble markets. Recognize that no one can predict when they'll burst. But avoiding these common mistakes, which we just saw, and maybe sticking to your strategy, you can protect yourself from the emotional pitfalls that bubbles create. And maybe it will help you to achieve longer term success in your investing journey. Now, next one, we'll talk about bull market mistakes. Next slide. So, some common errors that investors make when markets are rising. One that we have seen is fearing all-time highs. One common mistake is that fearing that every all-time high will be followed by a crash. See, while this fear stems from past instances, it's not always the case. Markets can continue to rise for years before any correction, significant correction. And sometimes selling too early means missing out on significant growth, right? Remember, time in the market always beats timing the market. All-time highs are a normal part of growing asset classes like equities. Over the long term, markets tend to align with earnings growth of a company. For instance, if Indian companies continue growing profits as they have done in the past, I think equity markets are expected to rise over time. See, in fact, if you see, go back in history and see, almost 75% of the time, 1 year returns after a market high have been positive, right? So here the table that you see clearly highlights year-wise all-time highs of the Nifty 50 index, showcasing how often the market reaches new record highs. Right? In 2024, Nifty achieved 59 all-time highs, surpassing the previous record of 58 in 2021, both reflecting strong performance. So, when should you worry? Not simply because of an all-time high. You should evaluate your equity exposure if the following are happening, right, together. Like, for example, valuations are extremely expensive, and maybe we are in the last stages of the earnings cycle, and there's euphoria of over-optimism in the market, right? So if these conditions are there, I think we should be worried. Otherwise, in the absence of these conditions, all-time high may not be a reason to panic. Maybe we need to accept that they are just a part of long-term upward journey, right? Rather than fearing these emotions or these milestones, it's important to stay focused on the long-term potential of the market, right? So if you're confident or you have conviction about that, then I think you should stick to your investments rather than walking out, right? Another mistake that we do is assuming that bull markets mean a constant, uninterrupted rise. In reality, even bull markets, there are temporary corrections of 10-20%. Add to this the constant stream of bad news and uncertainty. It's easy to feel like the market is about to fall. But here's the thing, markets tend to grow over the long term, and we have seen that in the past. So following the profit growth of companies, obviously, right? While bad news might create short-term dips, I think staying patient and ignoring these temporary corrections allows you to benefit from the long-term growth. So this chart shows the performance of Nifty 50 index from 1996 till 2004 or 2025 beginning, right? Highlighting significant market events along the way. As you can see, Nifty's journey has been marked by periods of growth, corrections, and recoveries. Right? Major events like the bubble burst, GFC crisis, and very recently the COVID-19 pandemic have all caused sharp fall or sharp dips in the market. However, despite this setbacks, the overall trend has been upward, driven by the long-term growth of companies and the economy. What this chart is telling us that markets naturally experience ups and downs, right? But these corrections or this declines are maybe temporary. I think the key is to stay sharply focused on the long-term trend rather than reacting to short-term declines, right? So this reinforces the idea that patience and discipline during market volatility are extremely essential to investment success. Right. Next slide. So, what can we do? Firstly, don't fear all-time highs. They're a normal part of long-term growth. Avoid reacting to every piece of bad news or minor correction. Bull markets have lot of temporary dips, right? We should focus on long-term growth driven by company profits and not trying to speculate on the price movements. Finally, stay disciplined. I think trust your asset allocation and avoid the temptation to time the market, right? I think by keeping these points in mind, you can navigate a bull market with confidence and avoid common mistakes that can derail many investors. Next slide. Let's talk about a common bear market mistake, which all of us have experienced, right? Exit now, enter later strategy, right? When markets fall, it's natural to assume things will only get worse, right? This leads many investors to sell their equities, thinking they will re-enter when conditions improve. While this sounds logical, but it rarely works in practice, and we have experienced that also, right? The challenge isn't exiting, right? It's getting back in, right? Bear market recoveries sometimes often begin with bad news, which is still everywhere, right? And recoveries mostly tend to happen faster than expected. Markets, as we all know, don't move in a straight line. They have falls, rallies, and declines, making it hard to time the re-entry, right? And if you miss the bottom, you may feel anchored to lower levels and maybe hesitate to invest again. And maybe you never get back in. And we saw that during the COVID when people exited thinking they'll get back in, and some of them just couldn't get back in. So again, we need to see how we can avoid this mistake. Next slide. So what should you do instead? Right? I think stay invested during market declines. I think this temporarily falls are part of journey toward long-term success in investing. Regularly review and rebalance your portfolio to maintain your target asset allocation. I think that's a much better way to address this emotion. And trust that markets recover faster than you might expect. We have seen it in the past many instances, right? Time and again. So by staying disciplined and avoiding the temptation to time the market, you give yourself, I think, the best chance to benefit from the long-term growth that equities have to offer. Right? Now that we have explored the gaps and emotional traps, right, that often challenge us as investors, it's time to talk about how we can handle them effectively. To guide us through this, I would like to invite my colleague, Senthil, to take over and explain some of the overarching principles that can help us manage these challenges and stay on track. Over to you, Senthil.
Thanks, Gaurav. Thanks for that. And good morning, everyone. So far in the first part, you have seen about what are the challenges that a normal investor faces during his investment journey in terms of behavioral side. So how the market sentiments impacts him and things like that. So now in the second part, we look at a couple of actionable items that an investor can do and which is in the control of the investor. So always within our research, I think we have a key actionable line item guide, focus on the controllables. So there are a lot of macro factors. There are a lot of company specific business factors, competitive actions. So these are things which are not in our control. But there are a lot many investment actions which are under the control of an investor. So if we just focus on his own controllables, I think his investment journey will be much more better than the an average investor. So that's where we will focus on this section. So first, like I mentioned, these are the key actionables that an investor has in his own control. So first is in terms of savings rate. Uh, so we always advise our clients in terms of having an optimal and rational savings rate. So it's not like going all in terms of having a 90-95% savings rate, like what a few people follow fire kind of thing. But always be rational in terms of in your investment behavior. So it starts right from the savings rate, and because the savings rate is 100% controlled by the individual, and it depends upon his own focus on his earning ability. So so Warren Buffett used to say that the biggest investment that the most important investment that you can make is in your own self. So an investor has to focus first on having a good earnings ability, and then maintaining the earnings ability, and then increasing the earnings ability over a period of time. So that obviously when a common man, when he's focused on his own skill set and enhancing his own skill set, so that will indirectly will be impacting this own savings rate on a positive side. So that's the first one. So having a good, rational, and optimal savings rate is important allocation, because without capital, there is nothing an investor can do in the markets, right? So this is the first and most important in the controllables list. So second, once you have a good savings rate and have a capital, one should focus on the asset allocation side. So as we see in the last couple of slides, markets always follow these cycles, and then we will have one asset outperforming the other, and then it depends upon a lot of macro factors and the government's actions and things like that. So uh, having a rational and optimal asset allocation in terms of either it be even within the equity also, we should have quite a bit of diversifications. So within equity, one cannot be heavily indexed towards a certain themes or a certain kind of market capitalization, for example, a small cap or a mid cap. So one should focus first within the asset allocation, how we can manage within equity, debt, gold, and things like that. And within an asset, you should have quite a bit of diversification. So that's the third in terms of what an investor can control. And then the last two are completely once the entire the capital has been set, he has to just be disciplined and then have a good investment horizon. So again, the investment horizon depends upon the life cycle of an individual, and then the kind of asset that he has invested in. Generally, for example, equities, it's always be suggest to have a 3 to 5 years kind of horizon. While on the other asset classes, I think it depends upon the what's the use that asset case has been built up. So I have a clear investment horizon, because without the clear timeline, it will prod us to make a lot of changes that will indirectly impact the our end result in terms of having a good outperformance for the market. So all along during this journey, I think one has to be always be aware of the portfolio risk. So portfolio risk may come in various factors. For example, at the start, one could have a good diversified asset allocation, but every year one should be very disciplined in terms of taking a review of the asset allocation, and then see that at at that current juncture whether he has a optimal asset allocation in line with his life cycle. Otherwise, as you go about 5 years or 7 years, I think there will be a lot of changes that will be happening within the asset classes in terms of one asset class could have tremendously outperformed, and that asset class weightage will be overweighting the other assets. So uh, having a timely review system should help in managing the portfolio risk. This is just one risk I'm saying in terms of the asset allocation becoming absolute. There are other kind of risks associated in terms of leverage, but optimally we are not considering an investor taking a leverage here. So that is one second most portfolio risk that we usually see in our clients. So having this five key controllables, I think one can build and then maintain, and then have a good end result in terms of his portfolio results. So that's the first in terms of what an investor can act this thing. And then second is prediction. Uh, so even for economic, those who done majors in economics, and then all those economists, and even for people who are in the investment field itself, I think it's very tough to predict, especially on the macro side. Just for an example, a couple of years back, post-COVID, there was a huge quantitative easing by the Fed, and then when the inflation was getting out of control, Fed decided to do a tightening, and at that juncture, right, what was the most of the prediction was that with Fed tightening, I think that's the end of the bull market, and markets are going to correct or have a steep fall. That was a major expectation from the market side. And we also seen that there was also this inverse yield curve phenomenon. So these are two couple of major macro predictions that happened in 2023, just 2 years back. But if you just, it's a hindsight thing. But now, after 2 years, we are seeing that the equity markets have continued to outperform the other asset classes. And so it shows that the past need not repeat now. And one should always uh, don't take any haste actions and disrupt the flow of the asset allocation or disrupt the flow of the portfolio just because of a few macro changes that may happen during the short term or mid term. And uh, so do not predict. Also, I think don't make any major changes to the portfolio because of any macro changes, because that may happen, may not happen. And even if that happens, I think over the long period, I think its impact on the overall portfolio will be quite minimal. So that's the second in terms of controllables. And next, if an investor, if you're suggesting don't want to predict, then what he can do is that be prepared. So preparation comes in various forms. So one of the preparation could be that having a good savings rate, and then having a good liquid cash in terms of whenever an asset class is becomes overvalued. I think he has prepared to take a call, and then along with his financial advisor, so he should be prepared to take a cash call also. And then instead of predicting, just be prepared in terms of how we can uh, go and act if the market falls. So we have seen in the last decade, so we have seen starting from the global financial crisis in 2008, and then over the last decade we have seen like 4 or 5 major corrections, so including COVID, and then we have seen a lot of global developed market issues in terms of Europe and China. So during these times, I think uh, having an optimal asset allocation could help you in having a preparing for this fall. Suppose if one is over indexed on equity during these times, I think behaviorally the fall will impact him, and you'll be unable to make decision at that juncture. So all those preparation has to happen during a phase of a market when market has no fear, or market participant exhibit that there is no fear in the market. So only during those times one has to take a cautious call and be prepared, so that when the opportunity time comes, I think you will be both prepared mentally and also on the asset allocation, or on the cash side. I think you'll be able to act. Otherwise, you'll be both behaviorally impaired in terms of taking a call. So that's the thing. Don't predict and just be prepared. So even this, I think it's completely in our hands, right? So that's where it comes under the controllables list. So next, in terms of holding. In the markets, or if you have been reading a lot of investment books, so most of them talk about stock selection, right? Stock selection and then buying. But in terms of holding and selling, I think only we have a quite a small lot of books, or small lot of people discuss about the discipline to hold and then sell. And so just for an example, just we have taken the last 25 years of historical calendar year annual returns of HDFC Bank and Nifty. So just to showcase at the end, you will see that having a discipline to hold your business, how it impacts one's return. So here you can see that over 2 decade, or 1.5 decades period, there will be a lot of instances where the business that you own either underperforms the benchmark, or there will be absolute underperformance. Uh, but taking a call just because of relative underperformance is not a good strategy. For example, in 2002, 2003, when was a big bull market, I think in 2003 when bull market started, we have seen that a couple of instances when a business can underperform the index, and even post that, here you can see that uh, 2009 and 13 there was a underperformance, and in the last 7 or 8 years, you have seen the business underperforming the index almost for half of the time. But taking a short-term view and then moving out of this business and getting into another one, the switching over thing, I think for a long period of time, I think it doesn't help, and it also taking action, it impacts your long-term compounding also. So just if the business has been well researched, and it's quite stable and fundamental, there is no structural changes in the business, I think one should be prepared to and have the discipline to just hold on to the short term underperformance things. Because you will see that the next slide. So over the last 2 decades period, we have seen annually calendar year. But now, if you see the entire plot, right, I think you've seen the kind of outperformance that the business has in. I think if the business is structurally profitable and structurally there is no change in terms of business operations, I think one should hold on to the business and have the discipline to hold. And as our founder says, right, that the key ingredient of the compounding is always the time. So that's the most important factor, and uh, it's always the friend of the investor. And you have to note that it's in a wonderful company only. So this won't work out in a company that is undergoing or looking towards any disruptive any business scenario. So that's third in terms of how one should be prepared to hold to a investment. And yeah, so as we discussed, The first one is the principle. So how you save and then how you asset allocate and then how you diversify. And the second one is in terms of maintaining the discipline to hold and then just leaving the business the company to compound over time. The returns will be the byproduct of these two major factors. So just to end this, you have seen what an investor should do, and now what one should not do is that even this is in the hands of the investor, reacting to short-term newses. So at present, so the last 2 decades, what we are seeing is that more and more the information flow has improved drastically. So if you're in the markets, you might have noticed the number of companies that do con calls on a quarterly basis has tremendously increased in the last 5 6 years. So we have seen at present, I think quarterly there are like 700 750 companies are doing quarterly con calls. So the amount of information that is coming out, and this is quarterly basis, even if you take monthly updates. So now you can see, for example, some sectors like automotive, you get monthly retails, monthly wholesales, and all those things come in. And even now, what we are starting to see is the media. You might have read like which automotive maker is having a market share in the last 10 days and 20 days. So based on the retail sales. So all those data, I think there is a lot of data that is ease of availability is good, but short-term 10 days, 12 days data or a quarterly data in terms of sales, market share. So these things, it's good to read and then have it in the repertory, but don't take any drastic changes because of a short-term impact on market share, something like that. So just for example, we have taken Tesla in terms of showing the drawdown versus the benchmark in terms of the performance. So you can see here that so even a company that is one of the largest in terms of market cap globally undergoes steep corrections, and this is majorly because of if you can just go back to this drawdown period, and you can see that there could be some news about their slowdown in sales growth or what happened in China in terms of their foray, things like that. But over a long period of time, I think one if he sticks on to the business which he understands and there is no structural changes, and if the company continues to maintain its competitive edge, and so there will be no need to take any changes. So so the news is good to follow, and even if you're not following, I think media will follow you. So that's where we are in terms of uh, the current stage. So a lot of WhatsApp groups you will be into, and you'll be getting a lot of news of the stocks that you would have invested. So just don't react, just read the news, understand it, and then just assimilate it. Uh, any change in the particular portfolio has to be well thought out. Uh, so if it is a drastic change, then obviously it will impact the long-term horizon of your compounding returns. So that's broadly. Uh, so we'll just take a complete comprehensive view of what we discussed in the part two. Uh, so ignore the noise and don't react. uh, Stick to your asset allocation and then have the discipline, and then create a reminder to rebalance your portfolio. Otherwise, if you're not having any reminders, I think obviously it will be tough to periodically having a review. And then so patience and sticking to holding on to stocks across market cycles, so that plays the key role in terms of the end compounding, whatever the IRR that you might expect out of the asset classes. So if someone is not sticking to any, if even any one of these things, so the asset class that he has invested could have outperformed his own portfolio because of his own uh, uh, changes to the portfolio. I think he could have missed the optimal return that he could have achieved. So that's broadly in terms of the part two. I'll just hand over to Gaurav to take the next section.
Yeah. Thank you, Senthil. That was really insightful. A lot of good data you've shared. Right. So let's focus on an often overlooked aspect of investing. Right, managing our own expectations. Many investment mistakes, I think, stem not from the markets, but from our emotions, biases, and unrealistic goals. Right? Senthil was talking about focus on controllables, and just by discipline to hold and not reacting to news, I think your portfolio can go a long way. Right? But to navigate these challenges, I think we need systems that keeps us disciplined. And how do we do that? Right? So, firstly, I think we need to create a structured financial plan where you clearly define your goals. It can be retirement, maybe buying a home or education, and link your investments to this financial objectives. Right, a plan provides direction and keeps you focused even during market volatility. Right, we need to also embrace uncertainty with a margin of safety. I think like life is unpredictable, and so building flexibility into your plan is very important. Right, so this means we need to have room for errors in our budget or timelines. It can be up or down, and maybe decisions to increase your chances of long-term success in achieving your financial objectives. Another thing is staying consistent, right? I think regularly reviewing your portfolio and rebalancing your portfolio, and sometimes automating your investments will help you in avoiding taking those emotional decisions, right? Another important thing is focus on processes and not outcomes. Success, I think, comes from sticking to a strategy, not predicting the future perfectly, but we can prepare. Uh, we need to remember that investment success is largely behavioral and not technical, right? If we avoid this impulsive decisions and we stay disciplined, I think we can achieve our goals and very, very comfortably navigate the ups and downs of market with a lot of confidence. That is what we lack during market volatility. But if we have such practices and safeguarding systems in place, I think we'll be able to handle it much better. Right. So moving forward, and just quickly take you through since we have discussed the importance of managing our own expectations and also discussing on how we can avoid some common behavioral mistakes, we'll try to tie back to what we are trying to do in Solitaire, our flagship PMS product, and what's its core investment philosophy. So at Solitaire, we believe that successful investing isn't just about picking the right stocks or trying to time the market or a particular sector, right? It's more about mastering patience, consistency, and being rational in portfolio construction, right? We have seen emotional pitfalls like over trading, trend chasing, sometimes panic selling, and herd mentality often derail even the most well thought out investment plans, right? These demons of investing sometimes can cause us to act impulsively, lose focus on our goals, and maybe ultimately miss out on the power of compounding, like as Senthil was saying, right? The principle and time is what we need to focus on. Returns are byproduct, but sometimes we can lose focus on that principle and time because of various reasons, right? But that's where Solitaire's approach stands out. Our philosophy is designed to help investors stay disciplined and align with their long-term goals by addressing these behavioral challenges, right? So our philosophy revolves around five key pillars. First is the long-term focus. We encourage patience and discipline, allowing the power of compounding to work its magic. Long-term wealth creation requires holding steady during market turbulence and sometimes resisting the urge to react to short-term news or trends. So that's what we do in Solitaire. We try to ignore and focus on the core philosophy. Right? So this approach ensures sustainable growth over time. Next is bottom-up approach. Our investments are grounded in robust fundamentals. By focusing on high ROC, ROE, and sometimes leverage companies, right, and maintaining a sectorally balanced portfolio, we minimize emotional decision making and provide a foundation of financial strength to the portfolio. So this enables our investors to stay confident even during challenging market conditions. A very high focus on risk management, right? Proactively managing risk is at the core of our strategy. We shield portfolios from impulsive market reactions, ensure that investors remain aligned with their goals while navigating market uncertainties. Low churn strategy. Frequent trading often leads to poor outcomes. At Solitaire, by keeping the churn low, we help investors stay disciplined and focus on the long-term objectives. And finally, the behavioral edge. So we are trying to help investors overcome some of the emotional biases like herd mentality or recency bias or speculating by consistently being talking to them to fight these emotions, right? Sometimes instead of reacting to market noise, we ensure that decisions are guided by fundamentals. Right? In addition to this principle, Solitaire's opportunistic reflects the idea of being greedy when others are fearful. Right? So this means we capitalize on market irrationalities to find value while staying true to our philosophy of fundamental and behavioral alignment. Right? At Solitaire, we don't just focus on returns. We focus on helping our investors master the behavior that drives those returns. Right? We help investors to navigate the market cycles with clarity, discipline, and confidence. By combining these principles, we ensure that our portfolios align with our investors' financial aspirations while helping them avoid the traps of emotional investing. Right? So next 1 or 2 slides, Senthil will just take you through some important points on the Solitaire portfolio.
Yeah. Thanks, Gaurav. And so as Gaurav discussed, so these are the key items that goes into our investment process. So next we will see that what's the outcome of this investment process, right? So you can clearly see that it's just an outcome of the investment process. So we just don't go and analyze just only the debt-free companies, but so the outcome of having taking urge in terms of good valuations and then competitive strength, all those things. So outcome is that we have a portfolio. So where relatively versus the overall market, so our strength of our portfolio companies in terms of balance sheet is quite good. So majorly you can so you can ask that why no debt is good. You might see that having debt could push up the ROE, etc. But if you see during any volatile times, right? I think a company which has a good balance sheet strength, yeah, the company has lot of options available for it during times of volatile markets. So those options are bigger wealth creating situations for a company. So that we have seen over the last decade or so. where companies which had the cash and which had a good balance sheet strength, and then when the opportunity time comes, I think those companies took a much bigger share in terms of market share, or they acquired a lot of companies at a good, very attractive valuations. So having a good balance sheet helps them sustain during tough times and also thrive during volatile times. So that's where our portfolio is also positioned. So another process outcome is that risk management. So here you can see that uh, during market corrections, so the portfolio of Solitaire has outperformed the benchmark. So in terms of drawdowns. So this is also an outcome of the investment process. So it shows the kind of risk management that goes into building the portfolio. Having a diversified portfolio, having a mix of B2C, B2B kind of companies in the portfolio, export-oriented companies in the portfolio, rather than having a domestic dominator. So all these mixtures in terms of diversifications at the stock level, at the business level, so enables the portfolios stability during any market or volatile scenario. So another outcome, uh, what we do in terms of stock picking is that it's not just that we buy at one level and then we just forget it and then we just hold it for long term. So we continuously iterate, we continuously review it, the stock, and then we. It's not that we buy at 50 and then once it crosses 100, okay, we have doubled, we will sell it out. So it's not like that. Here you can see that one of the stock where we have initiated and then there was a COVID fall. And then from there, I think you can see the kind of multi-bagger returns that we attained. But we didn't sell out once we attained a double or a tripled our money. So we continue to maintain or review the stock in terms of what kind of earnings growth that the business can bring in and what is the valuation that it's trading and what is the forward earnings growth and then next 2 3 years kind of valuation that we look at it. And then so it's it's a very investment process driven rather than just buying a stock at a particular level and then just selling out after it doubles or triples. So this is where the risk management and then the extra alpha comes in. So just for an example, how we initiated and then how we held on to it and then how we reduced our exposure. So just to showcase the investment journey that went into a particular stock. And then, so we have seen what are the key things that goes into investment process and what is the outcomes. And then this just what we have delivered over the last 3 and then our 5 years and then since inception, just for your reference. And yeah, so that we have come to end and
Yeah.
I'll pass it on to Gaurav to concluding remarks.
Thank you. Thank you, Senthil. So, as we wrap up today's session, right, let's see on what truly defines success in investing, right? At its core, what we have seen, it's more about mindset and discipline and maintaining a long-term focus, right? Sometimes not doing too much and inaction leads to more productivity, right? So some key principles to guide the wealth creation journey, and that what we follow here at iThought. Try to keep it simple. I think the best strategies are often the simplest. Focus on building a solid, diversified portfolio, avoid chasing trends or overcomplicating any decisions. Right? Patience definitely pays. Investing is about staying in the market, not timing it. It's a very important message. The longer you stay invested, the more you benefit from the power of compounding. But one should know your limit, right? Invest within your knowledge and comfort zone. Seek expert advice when needed. And you need to make informed choices. So if you don't know something, don't go for it, right? And stay rational. I think markets are going to rise and fall. That's pretty normal. What matters is how you respond to that, right? So better to avoid emotional reactions and focus on sticking to your plan. I think the financial world is always evolving. So stay curious, challenge assumptions. and keep improving yourself and your understanding about this market. Successful investing isn't about predicting the future, I think, but staying disciplined and with a very sharp focus on your goals. So I would like to thank you, all of you, for taking your time today. And I hope you are leaving with some valuable insights. Stay patient, stay focused, and stay committed to your financial journey. Wishing you all the success. Thank you. So any questions, you can just put it in the chat box and we'll be happy to take them. So I think there's a question whether there's any formula for facing challenges in investment. So there's no formula as such, but as Senthil showed how we should focus on controllables. I think if you just follow that, I think in the long term, you will come out doing much better and with a lot of less stress on your portfolio. So I think focus on what you can control. That is your principal, the money that you're putting in, and the time that you have. So strategize and create an asset mix, link it to your goals. And the best way to do that is to have a comprehensive financial plan in place. I think that's the formula. If you do that and keep reviewing it every year, it's just like doing a medical health checkup every year. If you keep doing that every year on year, keep revising or reviewing your financial plan and sticking to the whole plan, I think that's the formula to face any challenges that might come in investments. So I think whenever we sell any stock, uh, the sale proceed is again reinvested uh, within the PMS client's accounts. It's not sent to the client's bank account. So dividend and sale proceeds both are reinvested in the portfolio and it doesn't hit the client's bank accounts. So your question is that sale proceed is remitted to the investor or held within the PMS. So it is actually held within the PMS and reinvested into the client's portfolio. Any new PMS 10 lakh SEBI announced? No, so in PMS, I think still it's 50 lakhs minimum. There's another product or another structure which SEBI announced, which is sub 10 lakhs, but that doesn't fall under the PMS category. In PMS, it's still 50 lakhs. How often can the investor view their PMS portfolios? So we share the monthly report with all our clients, and we also share quarterly reports with all the transaction details and the portfolio reports and performance reports. And we also share before the end of the advance tax date, advance reports, so that it helps them pay the advance taxes. Apart from that, on an annual basis, once the financial year gets over and our audit is done, we share the audited portfolio statements with all the clients, which they can use for their annual filings also. So it's monthly, quarterly, and annually. Apart from that, whenever the clients are coming and visiting, or we are having a discussion with them, at that time we take the portfolio and have a discussion. Great. I think if there are no more questions, we'll end the session. Anyways, in the next slide, our contact details are given. You can reach out to us, and we'll be happy to get in touch and explain any of your queries or how the PMS works, and any other discussions you want to have. We'll be happy to have. These are our coordinates. You can follow us on Twitter, YouTube. We do post a lot of videos, and every Saturday we keep doing webinars, so you can go and check out those. And PMS at iThought, you can reach out to us on email, or there's a phone number. You can just drop a message and someone from our team will reach out and assist you. So once again, thank you everyone for joining. It was a pleasure hosting you. Thank you. Good day. Bye.
Yeah. Thank you. Thank you, everyone.